the head of Asia Pacific Research, head of Asia Pacific at Citi, Mohammed Apabhai, joins in right now to give us his thoughts on the same. Thank you so much for taking the time out and speaking with us, Mohammed Apabhai. You know, the US Treasury Secretary spoke to Bloomberg late last evening, and he mentioned that this is on count this week. We will see the imposition of the tariffs, albeit there is thought that Canada and Mexico might be exempted as well. So there's a bit of a pull down from what the earlier stance was. How big an impact on asset markets would a move like this have, to your mind?
Yes, good morning. I think that the impact is potentially quite significant. It really depends on how it is introduced and how it is imposed, and also how deep it goes and what the retaliatory effects would be. All the while we have in our minds what happened in the 1930s when there was the introduction of tariffs and it turned a recession into a depression. I don't think anybody really wants to go down that route, but I think that there is not some, I wouldn't really call it protectionism, but I think some rebalancing of the trade relationship is probably what is going on. I think the really interesting question is what the other trade partners actually do. Especially in terms of not so much with the steel and the aluminium, but more in terms of the sectors that would hurt the region more in technology, for example, or in manufacturing. Those would be far more significant, whether it's at the autos or mobile phones or computers or that sort of broad tariff. Now, I think the interesting thing is that Mr. Trump is executing on the things that he did warn us about on his website after he got elected. So I think that they are quite serious about many of these issues now.
I think the market will start pricing in what these heads of states have spoken about in the last maybe 72 hours on social media and otherwise. I mean, in answer to Trump's comments, the EU gave out a comment about what they could do, and Trump speaking about cars. So if talks were actions, then we are already in a serious trade war as we speak.
Yeah, I think that you know, it could be a negotiating ploy. I mean, he did then pedal back what he was saying about a trade war by linking it with progress in the NAFTA talks with Canada and Mexico. So with Trump, for example, it's not so easy to know what is bluff and what is the reality. I think that's part of the game that they're probably playing to extract concessions from the negotiations that they're looking at. Now, of course, the biggest part of the deficit is actually not with China or Mexico, is actually with not with Canada or Mexico, is actually with China. And so far, the steel tariffs are not having an impact on that trade deficit, which the Americans want to get down. So I think what is interesting at the moment is that the equity market and other asset markets are remarkably calm about the potential impact of this. We've had a look at, for example, the names that would be impacted if there was a trade war or trade tariffs. And what we've found is that certainly those names over the past year since Trump got elected have actually outperformed, and even in this recent correction have outperformed the broader market. So certainly in the equity market at the moment, no real concern of a trade war. It is the case that steel companies and aluminium companies, particularly the Indian ones, have been negatively impacted as a result of the developments we've seen over the past few days. But in terms of the broader market, no real impact yet seen.
Yeah, I saw your note wherein you mentioned that companies like SAIL might get impacted in a meaningful way if this indeed turns out to be true. So then what are the markets really worried about? Because if I've read your previous interactions, I mean, they may be television interactions, but I happen to read them on the site, you believe that yields, globally at least, the US yields, were close to their peak levels earlier. And if that is indeed the case, that's probably a net positive. Despite all of this, the last one and a half months hasn't been positive for markets. At best, volatile. At worst, in a market like India, a substantial downtick from where we were.
Yes. Well, I think India has got some of its own specific problems, relating to the banking sector, which you know about better than I do. Also, this MSCI potential threat to declassify from emerging market status basically is meaning that international investors who are already overweight Indian equities are not really being given a reason to buy more in Indian equities. The same is happening in Japan, where there's now a concern that the market will recorrelate with dollar yen, and even in Korea, where Samsung Electronics will be suspended for a few months, really foreign investors not being given a huge reason to be buying into those markets. I think the other thing that is happening is that volatility is continuing to remain elevated. So we look at this measure called covariance between the equity and the bond markets, and it's still above 8%, and that's more than double what it was a few months ago. And what that means is that it just keeps people on the sidelines. If anything, what we've been seeing in this region is that this bounce that we're seeing in equities has actually been used as an opportunity to sell into, rather than be buying more into that dip. And it's interesting in terms of styles as well. Value and quality are underperforming. Low risk is outperforming. And that normally is not a time when emerging markets really outperform. Now, our view is basically that if the equity market in the US breaks the start of year level, which is somewhere around the 2,700 region, what the next phase we'll see, so in this current phase, what we're seeing is a lot of rotation. The next phase will actually see some liquidation. And in that environment, we're expecting emerging markets to actually underperform the US equity market. So this outperformance that we've seen, this marginal outperformance since the start of the year, is vulnerable, but only if that start of year level breaks down.
I have a question on India, and I don't know how closely you would have looked at these variables, but the very point that you mentioned, that the rotation might well turn into outright liquidation if we break the lows of the early year. Now, that would probably for the larger mother markets, but India has managed to do that. Yesterday, we were trading at fresh 2018 lows with an assumption that we do not see any negative fallout of this MSCI issue, and we do see a resolution, and that we've seen the rough end of the stick emanating out of this PSU banking mess already. Do you foresee further pressures on India?
I think that we're not expecting actually any announcement from MSCI until probably the quarterly rebalance that comes out in May. So until then, I think what we're seeing is, the market is certainly turning short-term oversold. So the RSIs are getting down towards the 30-ish level. But I think that what we're going to see is foreign investors just staying away. It may not be the case that they necessarily come out and sell the market. It's just that they won't buy the market. And we're actually seeing that both in the bond market, the foreign exchange market, and in the equity market as well. And so the correlation between the three of those is actually starting to pick up. And so India, with its twin deficits of the capital account as well as the fiscal deficit, needs this sort of constant inflow to come in to plug the gap. And without that, what we're actually seeing is not just in India, but Indonesia, Philippines as well. We're actually seeing the currencies and the bond market weakening as a result of that. And of course, as the bond yields go higher, then there's an alternative source of investment or route for investment for certainly for domestic investors. When they're being offered 7.5% yield for sure, do you really want to be taking all that equity risk that you're experiencing? So I think those are the potential pressures that we have, but we think that there's going to be continued choppiness and volatility in the Indian equity markets until probably around this MSCI announcement, which we're not expecting until May.